Accounting for Accounts Receivable, produced, directed and printed by Ishan Gupta. Let's start with what is accounts receivable? Well, accounts receivable is based on the concept of earning money which has not been collected yet. To keep track of how much money an entity recognizes as revenue but does not have in cash, an accounts receivable account is used. Recording accounts receivable. To keep it simple, let's use the example of $100 worth of pens. Let's say that I am a shop owner and a customer named Mark comes to me to pay me the money late and buys these pens for $100. Now Mark doesn't have the money, so he promises to pay me the money later. So I credit sales and debit accounts receivable. Now I've recognized that I just made a sale of $100, but it still needs to be paid. Accounting for returns. Let's say that Mark overestimated his need for pens and has come to return $50 worth of pens. So I debit sales, returns, and allowances and credit accounts receivable because I can no longer expect to receive that amount. Accounting for discounts. Everyone loves discounts, so let's start again. Let's say that Mark has come to buy $100 worth of pens, but I have put up a sale, 15% off any purchase of $100. So I debit accounts receivable, assuming Mark still promises to pay me later, debit sales discount, and credit sales. Uncollectible receivables. These are receivables that you reasonably assume will not be collected due to various reasons. There are multiple ways of dealing with uncollectible receivables: direct write-off, percentage of sales approach, percentage of receivables, and aging of accounts. Individual entities decide which approach is most appropriate for their respective business models. Notes receivable. Mark walks into my shop again and I'm not so happy about that because he has developed a poor credit history. He says he will pay later, but he doesn't end up giving me the money. So this time when he makes a purchase of $100 worth of pens, I tell him to make a promissory note saying he will pay me a specific sum of money at some specific point in time. Promissory notes formalize the receivable or loan and usually require the maker of the note, Mark in this case, to pay the payee, myself, both the principal and some interest. When the day specified on the note comes, Mark will come to me with the $100 he owes me and I will return to him his promissory note. I hope this presentation gave you an understanding of accounting for receivables. Thank you.